Let me give you co-host. And John co-hosts. To what? The wrong person?
All right, we ready? Yeah. Okay, guys. Hey, and I could hear myself. I don't know if we could mute that somehow.
You can.
All right. Yeah. Well, over here on my end, I think at the office. I think we're good. Welcome, everyone. Today is Thursday, the 1st of June, halfway through the year already. And we're having our financial literacy workshop. Really happy to put on for you. 6 months in, time flies. So the sooner that we learn how to deal with our money, how to be financially intelligent, the faster we could grow our wealth. And again, June 1st, time flies. So I'm happy to be hosting this workshop here. Thanks for everyone that's joining online on Facebook. So let's get right into it. It's our financial literacy workshop. Before we do that, how about I share with y'all a calendar, right? So we have several of these. If you can, go ahead and take a photo, scan the QR code if you happen to be on your laptop with your phone. And these are the topics, upcoming topics: tax benefits of owning real estate, first-time home buying, home selling 101, budgeting your way to $1 million, ADUs for beginners, renting versus owning a home, and more. Okay, so if you guys want to join any of our future workshops, scan there. You could give us your email, and then at that point, you would start receiving these invites from us. Okay.
I also dropped the links on the chat.
Perfect. So Claudia, in case you don't want to, you can't do the QR code stuff, then just go ahead and click one of the links in the chat, and then you could either watch our pre-recorded or previously recorded videos on YouTube, or you could go to our LTP events page where you could just say, hey, I want to hear about any upcoming workshops. All right, next, if you find today helpful, you can review us, okay? You don't have to give us any money or buy or sell property with us, but you can jump on our review page on Yelp or Google or Facebook or Zillow. Just find your favorite Lepe Tendwell agent, whoever referred you, find them online, find the Lepe Tendwell company online, and please leave us a review. Okay, that's how you could show your appreciation to us for tonight's workshop. This is everyone here at Lepe Tendwell. There's a bunch of us, 20 something of us. This is probably not everyone either. So please thank your realtor by leaving us a review, by referring us some business. All right, so tonight's workshop I'm putting on, and we have a couple co-hosts. This is a little bit about me, born and raised in San Diego. I'm a full-time real estate broker and property manager. I have 50 tenants paying me rent every month, 50, and they're all here in San Diego. And I've done a bunch of deals, and my net worth and cash flow is enough to retire. Okay, that I reached that level of retirement a couple of years back, but we're still working hard, and we give a lot of money to our community. We give in over $100,000 to the local kids here in the community. So that's a little bit about myself and my company. And then also we have a co-host, Claudia Lomelí. She's here to answer any questions you have in the chat. You can raise your hand, you can message her directly. She's been a realtor here for a few years with us. And we also have John Gaxiola, he's also on the chat. So any question that you have, feel free to reach out and we could get you that information. So thanks, John and Claudia, for being here, joining us. All right, so I know that there's an NBA playoff game tonight, so I'll try to make this quick as possible that we can watch second, third, and fourth quarter, okay? So financial literacy workshop for adults. By the way, if you want to sign up your children for the children workshop that we're going to be having in a few months, please let John or Claudia know in the chat. First thing that we want to talk about is what is money, okay? If we understand this principle, then we're going to be able to understand money and how it works, okay? So Robert Kiyosaki said, the poor and middle class work for money. The rich have money work for them. Okay, so what does that mean? The poor and middle class work for money, meaning they get up and they go to work every single day, and the rich have money work for them. So let me break it down to you. First thing is, what is money? Most people associate money with their country's currency. In the US, it's cash, aka US dollars. And in Mexico, they use pesos. 2,000 years ago, people used silver and gold, and they still use it to this day. We use money to pay for goods and services. So that's what money really is, okay? So it's anything that we could use, whether it's gold, silver, pesos, US dollars, or seashells, right? Whatever somebody would accept for goods and services in exchange for goods and services, that's what money is. What is wealth? Wealth is an abundance of assets. And again, guys, I urge you guys to take notes. If you guys there, take notes. That way, when you write them down, you remember them a lot better. So again, wealth is an abundance of assets, aka valuable possessions, or money. So that an abundance of it. Wealthy people usually have a high net worth. This is the total amount of money and assets you own minus your liabilities. For example, all my friends that helped me with this workshop, because I did go to some friends, they all have a net worth of $1 million or more, meaning their wealth exceeds 1 million US dollars. That's considered a millionaire. Also meaning if they sold all their possessions today after paying off all their liabilities, they would have over $1 million. That's a millionaire. That's the definition of a millionaire. So what we have to understand, our wealth, some people call this money, is always invested in something. Most people's wealth is invested in US dollars because they never exchange or trade it for another type of wealth. AKA they never invest into something other than US dollars. And they don't understand or know this. So guys, that's the first thing we got to understand is that money could be anything, right? But if you only use US dollars because that's all you've ever known, then your money right now is losing value every year. And that's called inflation, right? Inflation, last I heard, was about 9%. And that means that your purchasing power, if you have $100 in your pocket, next year, you'll still have $100 in your pocket, but you're only going to be able to buy $91 worth of goods and services. That's it, $91, because you just lost 9%. That's what inflation does to money. Now, the other concept here that I'm going to break down is where the quote says, the poor and middle class work for money. The rich have money work for them. What does that mean? Let's take one of my tenants. Okay, I have 50 tenants in San Diego. They all wake up and they go to work to what? To make money, right? They're the tenants, okay? Now, the average tenant that I have goes to work for the 14 days out of the month belong to me, the landlord. So the first 14 days, they wake up at 7 in the morning. They get to work at 8 in the morning. They come back at 6 p.m. in the afternoon. So those first 14 days of them just grinding, That's to what? To pay me the rent that's owed to me as a landlord. So that's what poor and middle class people do. They go up, wake up every day and they go work for money to pay for their bills, for their food, for their apartment rent. What do rich and wealthy people do? They have money work for them. So for example, I own that apartment complex, right, where some of my tenants live. And I invested into that apartment building. I own that apartment building. So that money is working for me. I'm not working for that money. My money is working for me and is generating money babies, right? It's making money babies. So those tenants go to work for the first 14 out of the 30 days. You know, I own almost 50% of their time, which as a tenant, that's probably not a great feeling, right? Because the first 14 days belongs to their landlord on average, okay? Where I invested into that apartment complex. So now I'm hands off, my money's making money babies, it's working for me. And then I get money from that, okay? So that's the first concept of what is money. I just want everybody to understand that. And by the way, if you don't understand a concept, you have a question about a concept, raise your hand, unmute yourself, and you can ask a question, okay? And I'm sure Claudia and John are probably monitoring Facebook too for any questions there. Okay, the next thing is, I want to show you a chart of different ways to hold your wealth. So I did a chart in 2021 and a chart in 2022. If you had a US dollar in 2021, between 2021 and 2022, there's inflation of 8%. So if you held that $100, 1 year later in 2022, you would have lost $8 in purchasing power. It would have been worth $92. Gold did a little bit better. If you had $100 of gold, 1 year later in 2022, it would have been worth $97. So you would have lost only 3%. By the way, gold's doing much better now than it was back then. So now gold's kicking butt. I talked to my gold dealer today. And yes, I do have a gold dealer, a precious metal dealer. I buy silver from them and I buy gold from them, okay? I trade my US dollars for gold all the time. All right, investment home. If you would have invested your $100 in an investment home between 2021 and 2022, it would have been worth $107. So you would have earned 7% on your money if you would have done that. Disney stock, let's pretend that you traded your US dollars for Disney stock between these 12 months, you would have been down $38, 38%, because Disney stock went down during this time. So I want to show you this chart so you understand that money could be held in different ways. And once you start understanding that you don't need money in your bank, then you can go ahead and start figuring out where you want your money to be, okay? So the question here is, which of the above ways to hold money performed the best over the last 12 months? Obviously the investment home, right? Because you actually made 7% profit. Did you know 20 years ago, 1 ounce of gold was worth $271? 20 years ago, if you earned $271 at your job and you bought 1 ounce of gold, that same ounce of gold today would be worth $1,721. And by the way, I did this chart a year ago. Now that real number is $2,000. So gold's at $2,000. So just between last year and this year, gold went up almost $300, which is pretty exciting. If you had your money in gold, like I do, you know, my money went up. So I'm happy about that. 20 years ago, if you preferred to keep the $271 that you earned in the form of US dollars, today that same 271 would only still be $271, right? So you would only have $271. Now, if you factor in inflation, you would have less. Okay, but that's my point. Is one of my buddies one time found a bunch of money that his dad had stored in his garage. His dad passed away many years ago, and he has like all this old money from like 1970s, 1980s. And it wasn't a lot. I mean, it was a lot. It was like, you know, $5,000 or whatever, but it was like all this old money. And I just thought to myself, looking back, like, man, and he found it like 30 years later. And I'm just thinking, man, imagine if he would have traded those 5,000 US dollars for a stock, Apple stock, Disney stock, or if he would have traded that $5,000 for gold. And back then gold was like 30 bucks. I mean, it was a lot less, 30 bucks an ounce, you know, whatever it was worth. Or put that $5,000 into a down payment on a house. And back then houses were a lot less expensive. You could buy a house in San Diego for $20,000, $30,000. So it's very important that, and I'm assuming his dad didn't have a great understanding of how money works, or else instead of, you know, storing it in his garage for a rainy day, he would have traded it for something that's going to earn him more money in the future. Does that make sense? Any questions before we move on from this key idea here? Okay.
No questions, but just a reminder to give me their emails if they want to be added to our newsletters and future events.
Great. Thank you, Claudia. All right, here we go. All right. Next quote: money without financial intelligence is money soon gone. What does that mean? Well, that means all the lotto players, all the basketball players, all the professional football players that come into money, right? They get these huge paychecks, and then years later they're broke. Why? Because he says it here: money without financial intelligence is money soon gone. And that's why it's important that you know, if you really believe this right here, then that means that people who earn their money, who work their entire lives and save and invest properly, they're learning lessons along the way. They're taking L's, they're taking W's, but they're learning all these lessons. And that's why someone like myself, right, that a self-made millionaire, I earned all my money and I made mistakes along the way, and I learned I'm not going to lose my wealth. Does that make sense? It's going to be really hard. I would have to make, you know, not smart decisions for me to lose what I have, because I do have financial intelligence. So that's what we got to teach ourselves. Did you know just 40% of Americans have $1,000 in case of an emergency? This means 60% will go into debt when it does rain. So that's a pretty amazing stat, I would say. So out of every 10 Americans, 4 have $1,000 or more in case there's an emergency. And 6 out of 10 Americans would have to use their credit cards to pay for a transmission change, you know, brand new tires, you know, hospital bill, you name it. We got to change that. And everybody on here, I think, believes that. And that's why you guys are on here. 6:30 p.m. missing the finals game. All right. Do I continue this lifestyle, shopping, clothes, or do I have to sacrifice a little bit because this is important to me? That's going to be the distinguishing decisions that ends up separating the ones that end up getting with the ones that don't. Nipsey the Great, one of my favorite rappers of all time, he had to make a decision. Right? Does he spend and blow all his money on shopping and clothing and trying to look cool? Or in his case, what he did was he said, you know what, I can't do that anymore. And he stopped spending his money and he started investing his money. He bought equipment, he sold his fancy car, he bought studio equipment and started investing in himself. And then, you know, he quadrupled or even more his money because of that. So that's a good kind of thought process to go through. Okay, what is a budget? A budget is an estimate of how much you will earn and how much you will spend monthly. This past Sunday, I had the pleasure of sitting here for about 6 or 7 hours working on my personal budget. I hate it. It's the worst thing I do every month, but at the same time, it's the best thing that I do every month. Why? Because it makes me money, but it's boring. And I calculate every expense that I did the previous 30 days, and I add it all up, And it's not a fun exercise, but after I'm done, I feel really good because I know exactly how much money I got to spend for the next month. Budget your way to $1 million. So you could take a photo of this, or you could, write this note down here. And by the way, we have a class called Budget Your Way to $1 Million. It works. Okay. If you take away one thing from this entire workshop, I would say you take away the concept that you can become a millionaire by having a personal monthly budget. Okay, first thing, budgeting is the easiest way to become a millionaire. You don't have to make a lot of money to become a millionaire. You really don't. When I became a millionaire, I was earning about $150,000 income a year. Yeah, that's good money, but it's not like I was a doctor, earning $300,000 a year, or a surgeon earning $500,000 a year, or a high-powered attorney, or earning $1 million. $150,000. Nowadays that's like chump change, right? That's like nothing. If you're living in San Diego, but during that time, I would say it was the equivalent of maybe $200,000 to $225,000. So you don't have to make a lot of money, and by the way, if I made less, it would have just took me longer to become a millionaire. No big deal. 2, tell your money what to do monthly so it can work for you instead of you working for the money. We'll go into that concept in a bit. 3, what percentage of your money should you save? We're going to go over that. And 4, budget monthly using an app. And 5th, this is a team effort. Your significant other has to be on board. We'll go over that concept in a bit. All right, first concept, tell your money what to do. So either you could take control, like this guy right here, or you could be controlled with your money, giving you, having a strong hold on your neck. And that's what most Americans do. You let your money control you instead of you controlling your money. So we're going to go over the envelope system today. This is one of the easiest, simplest things that you could do. And what's the envelope system is whatever amount of money you make every single month, you put it into an envelope and you name it. So you name the beauty, if you get your haircuts or your eyelashes done, and you have your beauty envelope, you have your fun envelope, so you could go out and, go to movies and eat out and enjoy yourself. You have your food envelope right here. This one's miscellaneous. And this is your gas envelope over here. It's kind of hard to see. And this is for your pet. So that's kind of the different categories using the envelope system. So think of the budget categories that need a cash envelope. You have entertainment, clothing, gas, restaurants, personal, gifts, hair. 2, and by the way, you can take a photo of this so you won't forget. 2, figure out your budget for each category. Most people overspend on things like food, coffee, birthdays, baby showers, etc. Create a budget for each category and stick to it, right? Who here wants to be invited to less birthday parties and baby showers? It costs so much money, right? It's you have to have a budget for it, right? You just can't go to 10 birthday and baby showers a month. You'll go broke, right? So maybe you create a budget for yourself and say, hey, like, I'm going to create the present for the next 10 birthday parties I get invited to, right? And you have a budget and you get creative and you make something, you make a nice card, right? Or you learn origami and you fold up a nice $5 bill. Something, if they're into airplanes, you do an airplane origami. If they're into race cars, you do a little car origami. I don't know. You have to get creative because it is expensive to have friends and to have family and to have a life. 3, create and fill cash envelopes for the budget categories. Pretend you budget $500 a month for groceries and you get paid bi-weekly. Then you get your first paycheck for the month. You take out $250 and you put it into an envelope and write groceries on it. Then on your second paycheck, you take another $250 cash and you put it into the same envelope. So this envelope system, you could create budgets for yourself that way. For spend only what you have in each envelope. You will be tempted to use your debit or credit card or cash from other envelopes once you run out of entertainment money for the month, but don't do it. Get creative. Go on a hike for entertainment or turn on Netflix. After the first time, it will get easier. So I get it. Hey, let's pretend you have an envelope for entertainment and it says entertainment, whatever. And then you go to a Padres game and then you're right there having a great time with your friends and you don't want the party to end and you run out of money from your entertainment envelope. Most people will take out your credit card or money from somewhere else and go into debt, let's say, just for the entertainment. I'm not saying this is easy. This is hard, right? And the biggest reason why millionaires become millionaires is because they have a lot of discipline. Discipline is tough. Ask anyone who's ever tried to go on a diet or to do a workout routine where you're like, okay, I'm going to wake up tomorrow morning at 6 a.m. no matter what, and I'm going to go to the gym. That's discipline and that's hard. But it could be done. How do I know it could be done? Because I see people with six packs walking around and guns, big muscles. Just like, okay, it could be done. Like somebody did it. It's not impossible. All right. So the next concept is pay yourself first. Always pay yourself first, no matter what. What does this mean? This is poor people. They get income. They buy what they want, entertainment, whatever's fun. And then they use the rest of the money for expenses. They go broke. They're poor. Middle class. They get their money, they pay expenses, and then they pay what they want, for extras. They want to buy the new Jordans that came out, and they do that. Rich people, they get income, and then they invest that income. Okay, they pay themselves first, right? They invested in this high yield savings, some treasury bonds, stock portfolio, real estate, and then they use the rest of the money to pay the expenses. Their living expenses, their rent, their car loans, their realtor fees, whatever. And then if there's any money left over, then they buy what they want. Okay.
We have
Claudia?
a question
Yes.
in the chat, but you can finish this.
Okay. All right. So the final thing here is this means saving 20% every dollar you ever earn, reinvesting that 20% into a safe stock account that earns you 5% over time. So pay yourself first. All that means is when you get your monthly paycheck, and your monthly paycheck, as an example, is $1,000, you take out $200 out of that $1,000, and you pay yourself first. You put it into a savings account. You buy a treasury bill. You can buy some stock. It's a long-term game, and that's it. And then you spend the other $800 on whatever you need to spend it on. Going into this question, Walina asked, I don't take out my cash when I get my paycheck. How can you implement the envelope system when you don't use cash? Great question. The envelope system is a way to where you just can't fail. You cash your entire paycheck, you have your envelopes, and that's all you spend. You don't use your credit card or your debit card. However, and that's changing, by the way, because now I walk into a cafe and it says no cash, credit card only, right? So I get it. So the way you do that is you have a high level of discipline, number one. Number two, you have your personal budget that you do every month, which we're going to go over in a bit. And then number three, I would use a cash tracking app. Okay. So just like Mint, the Mint app, and in there you write down your goal. So your goal is to spend $500 on groceries for the month. You type it into the app. And then let's say you go to Whole Foods and you spend, $120 for a bag of peanuts and a soda. So now you type in bag of peanuts and a soda on the app, $120, and there's only like one person that got that joke, but and now on the app, it's going to go from 500 to 380 left. So now you know exactly how much is left from the $500. So you can implement, Willina, the envelope system via the app. You put 500 for groceries, 300 for entertainment, 2,500 for your rent, 700 for your car note, and you go down the list, and then you fill up these envelopes on the app. And then as you're spending that money every month, you put how much you spend, and then they'll tell you how much you have left. Great question. So the answer is using an app on your phone. All right, saving money. What does it mean to save? Pay yourself first is saving. That's what saving is. Pay yourself first. Most people earn money, then pay everyone but themselves. Who's guilty of that? I think all of us, me at one point in my life, I would get my paycheck and I would just pay everybody else. I would pay the coffee man, I would pay the rent landlord, I would pay my car note, I would pay all my bills, utilities, grocery store person, my shoes when I go to Foot Locker. I wouldn't pay myself first. Yes.
Yeah, and I think another misconception on that, or how I used to perceive it, was like treat yourself first versus like pay yourself first and save it, because it was always like treat yourself first. So it's
Got it. Maybe a lot of us perceive it that way, right?
Yeah.
Treat yourself first. So when we say pay yourself first, that just means save. All right, save. And the way you save is you pay yourself first. As a general rule of thumb, you should save at least 20% of all your income you ever earn. Let's pretend you have a regular job, pays you $5,000 a month. When you get that paycheck of $5,000, 20%, which is $1,000, you put it away. You save yourself. You pay yourself first. Save it. And then let's pretend you have a side hustle, Uber or Lyft driving, and you make $1,000 in a month. The first 20%, which is the first $200, you put it in a savings account. And guess what? Over time, it grows, and it grows fast. But you have to have patience, because if you don't have patience, you're never going to be able to save money. There's a question from Alejandra. Can you connect the app to your bank account to keep exact track of how much money is spent? Yes, you can. So there's apps, and Mint, you can probably do that. I used to have a cool app where it would tell me my total net worth. It would have like all my mortgages on there, would have like all my bank accounts and all this stuff. And it would tell you, every month it was going up and down. Now I do that same app, but I do it in paper. I write it down every single month. It takes me forever. It's not fun, but that's how I do it now. So to answer your question, yes, you could connect the apps to your bank account. Great question. Okay, so here we go. Always save 20% of your paycheck or income. Most millionaires didn't become millionaires because they made a lot of money, but because they saved a lot of money. Then later, they bought assets with those savings. By the way, I have a quick, let me read this first. So I have a friend, he has $103 million. Let me repeat that. I have a friend, he has $103 million cash net worth, and it's on the stock market. He's been investing into the stock market every month consistently since 1984 or 94. Either way, long time, 25 years. This is his number one advice for us to become millionaires, because I said, hey, look, I'm doing a class. What do you suggest everyone in here does in order to become wealthy? And his number one piece of advice is, he said, save and invest 20% of all your income / allowance. Download the Robinhood app and buy 10 stocks you like, and keep doing that with all the money you earn forever. That was his number one advice. This was a little bit over a year ago. Stock market since took a dive, and then it started going back up. So now his updated advice is save and invest 20% of all your income and allowance. Download the Robinhood app and buy the S&P 500 and the QQQ, which is another index fund. So that's his updated advice. Okay, you put 80% in the S&P and 20% in the QQQ forever and ever and ever, and you'll end up with a lot of money. All right, we have a quick question. What asset classes did you buy when you had very little savings? What assets did you buy as your net worth grew? Awesome. So I bought real estate. So I just saved my money. I wasn't investing into the stock market. I should have. I would have had a lot more money. But at that point in time, I was saving my money just in a regular bank account. And then once I had enough, I bought my first property, and then my second property, third property, and I just kept going that way. Now that my net worth grew, I still buy real estate on a yearly basis. Now I started investing into the stock market, and I put money away on a monthly basis. And then I buy precious metals like gold and silver. And what else? What other asset classes? I invest in notes. So I lend money to people as well for an interest, for return on investment. But my main thing is real estate. I'm really good at that. I have a question. Is it easy to pull money out of your stocks if you need to use it? Yes. Great question. You can pull money out of your stocks. So for example, I'm buying a property right now. I might need some money, and I do have a stock portfolio. So I have in place something called a line of credit. So if I end up using it, then I'll probably end up borrowing 50% of up to 50% of whatever my value is. So for example, if I have $100,000 in there, I could easily borrow 50,000 like that. And I still have $100,000 working for me in the stock, but now I have a loan against $50,000, and then now I'm paying interest on that loan. So yes, it is easy to pull money out of your stocks if you need to use it. There's two ways to do that. And I might have misread the question. One way is to borrow against it. And the second is to just sell your stocks. So right now, if I wanted to, I could just sell my stocks, have a bunch of cash, and then go and buy, another piece of property. Great questions.
One more quick question, Voltaire.
Yes.
Someone's asking, if I have a 401k, how can I use that money to purchase real estate, and how?
Awesome. Great question. Just like I mentioned earlier with a regular stock portfolio, so you could go to your 401k, you could borrow against it, right? So you just basically pull a loan against your 401k, and then you could use that as your down payment. And then from there, since it's a 401k, you work out a deal with the 401k company where they give you X amount of time to pay back. So yes, so you could borrow from your 401k, you could borrow from your regular stock portfolio, which actually, now thinking about it, John, that question just sparked something in my head. Maybe I should just borrow against my 401k if I end up, because I think it's a little bit better as far as pricing. Thank you for those questions. Someone asked, can you borrow against your Dogecoin, Bitcoin, cryptocurrency? You probably can. I've never done it. I never met anyone who has told me they've done it. So I'm not sure about that question, but if you have your cryptocurrency, probably like with one of those banks, right? Wells Fargo, Morgan Stanley, Chase, and your portfolios with them, then I'm sure it's a security. So therefore you could borrow against it. Yes. If you have it with Coinbase or something like that, I don't know what their terms are. My pleasure. Okay. All right, so now we're gonna move on. But guys, remember, it's all about saving. This guy that's worth so much money, his only advice to you guys is just save 20%, invest it, and just do that forever and ever. He's never missed a month of putting money away. Never missed a month since he started. That's discipline. Even on hard months, he's never missed a month. Cool. Track your spending. What expenses should you track? Everything. Track your every single penny that you spend, literally, and make this a daily habit. I'll tell you a quick example of this. When I first got serious about becoming a millionaire, this is exactly what I would do. I downloaded an app, and this is like one of the first apps ever to come out, and it was like so basic. It was like the ugliest looking app you'll ever see, but I was able to track every single penny that I would spend. And it got to a point where I would, if I put quarters in the meter, like parking meter, I would put quarters, and then I would take out my phone, and it takes a time, like, you know, it's not like that, you know, I would have to go in there and be like 25 cents, parking, whatever, categorize it, hit save. And I would do that for everything: food, clothing, tip. So if I left, you know, if I bought a latte at the coffee shop, I would put, you know, $4 for a latte, and then I would put like $1 for the tip, and I would type in $1 for the tip. So it got to a point where my girlfriend at the time, she would get upset with me. She'd be like, dude, it's just a freaking quarter. Like, what are you doing? You know, like, you're taking forever. Come on, you know. Also, I was that person that would like risk, you know, messing up my back, because I would like be bending over, like picking quarters and nickels off the floor. And then, so to me, that was income. So then I would pick up like a nickel off the floor, and I would open up my app, and I would put like, oh, 5 cents added to the income column. And then I would just, you know, name it like for extra or miscellaneous or whatever. But it was like, it was that to that point. So imagine doing that, tracking it. And every month I would be like, oh my gosh, I'm spending too much. And the next month, the goal was to spend less or to make more. And I was playing that game with myself every single month. And guess what? Would I say 5% of that nickel? Well, actually, it's 20% of the nickel, which would be 1 penny. And I know I wouldn't, I wouldn't go that into detail. But what I would say is, I'm giving you this example because it could get annoying. You know, it was annoying to me. So I can just imagine that it's probably annoying to other people, you know, around you. But guess what? I was very serious. I was very serious about saving and becoming a millionaire. And that's why I did what I did. All right. Someone says, congratulations on being a millionaire, inspiring. Thank you. By the way, guys, this is why I'm sharing it. I'm not the type of person that I ever wanted to share, hey, you know, I'm a millionaire, blah, blah, blah. The reason why I'm sharing this is because that's the only way that I could actually inspire people, right? Because millionaires that I've met have inspired me, right? Because they tell me about their stories and, you know, all the properties that they got and all this stuff. And to me as a kid, I was like, oh my gosh, man, you know, I want to be that. I want to, you know, you're a regular person. So I felt I had to give back in that way by sharing. And then therefore someone, you know, picks something up and they go, you know what? I should be doing that. You know, he's a regular person. I should be doing that. Cool. Thank you. Yes, they should be teaching this at school. This is Nipsey Hussle right here. This is John Gaxilla, co-host tonight. I had to take 2 steps back to take 10 forward. So guess what? If you have to take 2 steps back, if you have to sell, you know, your expensive purse or get rid of that really nice car in order to start saving and start investing your money, that's taking 2 steps back. But the goal is to take 10 steps forward after you do that, right? So that's the whole point. All right, pay off your debt. Concepts. Let's go over these concepts. Concepts of money to consider. Number 1, when you pay cash, it always costs less. You save or you make money by paying cash. A simple example of that, when I go to the farmer's market and I buy some groceries, I always ask them, hey, is it cheaper if I pay cash? Right? Because sometimes they charge like 50 cents or $1 to use your credit card. And if they say yes, We won't charge 50 cents, you know, if you pay cash, then I pay cash. That same concept works in real estate. Once you get to that point, and if you buy the property cash, number one, the price is going to be less. But number two, you don't have to pay interest to the bank every month. So we have to understand this concept. All it is a concept, guys. And I want you guys to understand it, that if you pay cash, it always costs less. Two, when you finance something, it always costs more. It's just the same concept, opposite. So anytime you finance your car, for example, if you buy a $20,000 car and you put a loan on it, it's going to cost more than if you pay cash. Because if you buy it, you don't have a monthly payment, aka you don't pay interest to nobody. But if you finance a $20,000 purchase, all of a sudden you're paying interest to the bank. Okay. Cash on hand versus carrying debt. So let's go over that concept. It's number 4. It doesn't make sense to have $10,000 cash for an emergency if you have $15,000 in debt. You should use $10,000 cash to pay your debt down to $5,000. Why? Because if you have $15,000 debt, you're paying somebody to borrow that $15,000 in debt. You're paying the credit card company, your car company for the car note. So if I was in this situation, guys, okay, if I had $10,000 cash in the bank or under my bed or something, and then but at the same time I have $15,000 in debt, I would use the cash to pay off $10,000 in debt. And at that point, I'll be in $5,000 in debt, but I will be saving money at that point. Okay. I just want you guys to understand the concept. That way we're on the same page. Does everyone get that concept? And you know what? I might have to take out the calculator just to show you guys that concept, okay? Because this is important right here. If you understand this, you're gonna make money. So just let me share this with you. If you have $15,000 in debt, you guys can see my calculator. And let's say it's credit card debt and you're paying 18% interest on this. That means you're paying $2,700 a year. You divide it by 12, you're paying $225 a month just to borrow the $15,000. Now, all the while you have $10,000. So remember these numbers, write them down, Claudia or John, for me. $2,700 a year you're paying for your $15,000 credit card debt, or $225 a month. All the while you have $10,000 in cash earning 0% interest underneath your mattress, at the bank, whatever. You're making 0. So what I suggest is your $15,000 debt, you pay down $10,000. So now you only have $5,000 in debt. $5,000 in credit card debt at 18% interest. Now you only pay $900 instead of $2,700. So you just said $1,800 a year. AKA now you're only paying $75 instead of $225. So 225 minus 75. So you just saved $150 a month. So you're making $150 a month on your $10,000 that was in your mattress. So now you're earning interest on your $10,000. You got to look at it that way. Do you guys get that concept? Okay,
Yes.
great. Thank you. That's an important concept to understand, okay? How money works. When are you paying interest? When are you not? All right, the next thing is ways to eliminate debt. Number 1, create a family budget. 2, use cash on hand to pay off all debt. 3, stop bringing on new debt. It's hard to get out of debt if you keep bringing on new debt, right? So pretend you have a house and it's cluttered and you say, I want to declutter. And then you start throwing stuff away, start giving stuff away, start selling it at the swap meet. But then at the same time, you're going out getting new stuff and bringing it into your house. It's never going to get decluttered. So the same way this works. If you're trying to eliminate debt, you got to stop taking on new debt. Use the envelope system. We went over that. Use the debt snowball. We'll get to that in a bit. Stop loaning money to people. That was one thing I had to master, is say, hey, sorry, I can't loan you money. Because I used to loan people money, and that's a very bad habit if you're trying to become financially free. Don't co-sign for anyone. Okay, that's important. Do not co-sign cars, houses, nothing. Stop cash advances. So if you're borrowing cash advances against your paycheck, stop it. It's costing you money. And it's easier said than done, but if you use a family budget and the debt snowball system, you can stop cash advances. Last one, pay cash instead of credit. You have a monthly cash flow plan. By the way, we could email all this to you. That way you guys could start using this. So this one, it's a little bit harder to read, especially maybe if you're on your phone, right? But going back to the app, somebody asked about the app earlier. How can you do it without the envelope system? You could do it by having a monthly budget. So this is like a monthly budget kind of. So you have $10,000 a month that you make as a family. And then you start saying, I budget 1,000 for groceries, 250 for restaurants, and you write it all down here. Same thing with charity. Okay, I'm gonna give away 10% to charity, $1,000. You pay yourself first. This is the first thing you do. Savings, $2,000. So you if you earn 10,000 a month, you put 2,000 for savings right away. And then, if you want to give away 1,000 to charity, and then food, $1,250. Then you have transportation, $500 for gas, and housing, utilities. So you write down all your expenses: insurance, entertainment, your car payments, your credit cards. So the goal is you zero this out. This is zero-based monthly budget. So if your take home is 10,000 a month, at the end of the day, right here at the bottom right-hand corner, you spent 10,000 exactly. You don't spend 9,000, you don't spend 11,000, you spend 10,000, meaning every single dollar is accounted for. So that's another thing to realize, is that you have to zero out your budget. If you earn $10,000 a month, you have to spend 10,000. Nothing more, nothing less, because you're telling your money where to go. Does everybody understand that concept? Zero-based budget. Okay, great. And someone said I could zoom in. I didn't know I could zoom in. How?
I think she meant people on their phone.
Oh,
I don't know.
yeah. Okay, cool. Saving strategies. 1, start today. 2, set a goal. 3, change your direct deposit. This is huge. Change your direct deposit. So if you have a W-2 job, you make the same every month. Let's just pretend you make $10,000 a month. You tell your direct deposit person at HR or however you guys do it, or your bank, that as soon as the 10,000 comes in, immediately 2,000, 20% goes into a savings account automatically. Once you start automating this, easy, because you won't even see that money. Instead of seeing 10,000 in your account every month, you only see 8,000, because the other 2,000 went into your 401k, it went into your stock account, and went to savings account. That's what I had to do when I started investing in the stock market. I started automating my monthly deposits into the stock market. And then saving strategy number 5 is use an app. Investment types. I'm going to kind of speed through this, okay, because it's already kind of running late. But investment type number 1 is where you live. In life, you will pay off a home, guaranteed. You will, for sure, 100% pay off a home. But you have to decide if it will be your home you pay off or your landlord's home. Okay, The decision is yours. Are you going to pay off your personal home or are you going to pay off your landlord's home? And again, I talk to my tenants all the time. I talk to them about buying a home. I love them because they pay off all my mortgages every single month. They're paying off the homes for me. And a lot of them don't want to pay off their own home. You know, it's scary. I get it. It's scary. That's why they don't want to do it. But, you know, it beats paying off my mortgage. Investment type number 2. You could buy multifamily. You could buy a triplex, a fourplex, a duplex, instead of buying a single family house. Okay, I love that idea, but that's a more sophisticated idea. You could come to me later if you have questions, or reach out to your favorite Lepe Tendwell real estate agent. Investment type number 3, you have stocks. So you could own a piece of a publicly traded company. If you buy the S&P 500, you own the top 500 companies in the United States. So why do I like the S&P 500? I like the S&P 500 because you're betting on the US. And historically, the US has always gone up. And if the US tanks and defaults, guess what? Your money's worthless anyways. So either way, it doesn't matter. So I like owning the S&P 500. Investment type number 4, precious metals, gold and silver, like we talked about earlier. Investment type number 5, you know, art, painting, sculptures, etc. Investment type number 6, businesses. Start your own business or buy a franchise. Somebody asked me earlier what I invest in. One thing I didn't mention, I invest in business, right? I have a real estate company, I have a property management company. I invest money into the businesses over the years. That's another one that didn't come right to the top of my head. All right, so guys, part of this workshop, I put together this workshop with a bunch of millionaire friends that I have. You guys can take a photo of this. This is number 1 advice from each one of my friends. I called each one of them and I said, hey, I'm putting on a workshop. What piece of advice do you have for each individual in this workshop for them to make money? And I have a bunch of friends. And if you see the first friend, he's worth $225 million. And his advice is very simple. It says, read. Imagine that. And I was like, it was funny because when I was asking him, it was via text message. And I just saw that he wrote read. And I'm thinking like, okay, I'm waiting for like, you know, the little iPhone bubbles to pop up to see like he's still typing. And that was it. It was just one word. It says read. And what he meant by that is you could literally get whatever you want, live the life that you want if you educate yourself, if you read about it, if you join workshops like this, okay? And then, and everyone in here, a lot of these people, look at the person who's worth 6 million, they said save, even if it's $1. The person worth 3 million said save, save, save. Save what you want, then spend the rest, not the opposite. Person that's worth 12 million, save and invest those savings. Like, this is crazy because all these millionaires, a lot of them say the same thing over and over, save, 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 save. And that's one thing that's boring to us, right? Because trust me, it was boring to me too when I was like, man, saving, like if I'm saving only, you know, 20% at a time, you know, if I'm saving $100 here, $100 there, it's never going to amount to nothing. I thought it was the boringest thing, but it works. Okay. Start with whatever you can. Questions and answers. You can unmute yourself, type in the question in the chat box. Go ahead and unmute yourselves if you have any questions, comments. And by the way, here's a calendar. If you want the calendar for the rest of the year, we have 2 workshops a month, different topics. If you want the calendar, scan the QR code, or if you already gave us your email, Claudia and John will send you the list via email. You'll get invited on a weekly basis. What questions, comments about financial literacy? And by the way, this was just like a few simple concepts that I want you guys to use so you can get better. There's more stuff that I can't teach you right now because you need to understand and practice the basics first. And then we could get into the more heavy stuff. How much money should be good enough to start stock trading? All right. I don't like the word trading, right? Stock trading. I like the words investing into Fortune 500 companies or to the S&P 500, right? A lot of people go broke trading stocks, right? So the answer is, if you want to invest long-term, this isn't a short-term gain. If you look at it short-term, you're going to lose. If you want to invest long-term over the next 30 years into the stock market, you can start with $10. So if you're making, $50 a week by cutting lawn, and 20% of that $50 a week is $10, you just do $10 at a time, and you save it and invest it into the stock market. 30 years later, you'll be a millionaire, guaranteed. But what we're not doing is buying stocks, reselling them for a profit. We're not doing that. We're just letting it ride and letting it accumulate. It's called compound interest, which, there is a slide. We have a compound interest. We don't have it here, but it's amazing how it works. It just keeps compounding over time. And if you don't know what compound interest is, it's definitely worthwhile looking it up. What questions you guys have? Comments, anything? All right. Right now, since there isn't any questions or comments, I'm going to show you one more thing. But I want you guys to practice this stuff. Reach out if you have any questions. Also, I would love a review. I would love a review online, and just let us know what you learned and if it was any good and valuable. So this is an initial investment calculator, compound interest calculator. This is how it works, guys. If you invested today $1,000, okay, and monthly you contribute, let's say monthly, okay, so let's pretend you make $5,000 a month, and every month you save 20%, you invest $1,000 a month monthly. And let's say that you're 30 years old today and you want to know what you'll be earning when you're 60. So you put 30 years in there, length of time. So for 30 years, you invest $1,000 a month into the stock market. And the stock market, and this is, I'm going to show you guys in real time, average return of S&P 500 over 30 years, okay? 9.773%, you see that? So if you earn a 9.773% over 30 years of investing 20% of $5,000 monthly income, and it compounds annually, let's see how much money you would have in 30 years. Wow, $1.907 million by just investing a measly $1,000 a month consistently for 30 years straight. This is how much money you would have put into the deal, the green line. So the green line shows you that you would have put $361,000 of your own money, right? And then the red line shows you the future value. So you would have earned about $1.5 million in interest. That's compound interest. That's how it works. So $1.5 million is somebody else's money, and only $361,000 over 30 years is your money, right? So who doesn't want to have close to $2 million 30 years from now? Okay, who does want to have about $2 million 30 years from now? Yes, me, right? And all you have to invest is $1,000 a month. Kurt said yes too. Thank you, Kurt. This is compound interest. And that's why this famous person right here, compound interest Shit. There you go. I'm not that smart. Einstein. How do you spell Einstein? There we go. What did he say about compound interest? Right. He said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So if you have credit cards, what are you doing? Claudia, help me. Somebody help me. If you have credit cards, what are you doing?
You're paying it.
You're paying compound interest. Einstein said this. He said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So guys, you got to ask yourself the question, do you want to be the person who pays it or you want to be the person who earns it? I just showed you what $1,000 a month could do.
Preach.
No, yeah. Nobody has nobody in here should have an excuse as to why you're not rich 30 years from now. Now, you know what I'm saying? It's going to take time. All
We
right.
have two questions, two quick questions. Should you still invest while paying off debt?
Depends. I just showed you what you could earn, 9.7% if you're investing on an annual basis. So if your debt is more than 9%, I would pay off the debt first. It's really hard to become rich by having debt. So if you have a credit card and you're paying 18% interest, pay off the credit card first. You'll make more money there. If you have a credit card where you're paying 12% interest, pay off the credit card first because 12% is higher than 9.7%. If you have a car loan, credit card, that's 5% interest payments. If you have a mortgage that's 5% interest, 6% interest, yeah, you can invest because you're going to earn 9% over time, 9.7%. Great question. Kurt, you mentioned saving your way to buying your first property. How much did you save and how much did the property cost? Did you, and I can't see that. Okay, see that? Did you something?
It says, did you use a loan? If so, how much was the interest rate?
Oh, great question, Kurt. I saved $50,000 for my first property, which is a mistake because I could have bought a property, Claudia, with how much down?
3.5.
3.5%. I messed up. That 50,000 was for a $200,000 property. So I saved up 25% down payment. I wasn't smart about it. I should have only saved 3.5% down and bought a lot sooner. So I could have literally bought that same house for $7,000 instead of $50,000. So lesson learned. Now I know that the lower down payment I could put, the better it is. Second part of the question is, did you use a loan? Yes, I got a loan for the difference, 75%. And the interest rate at that time, I think I paid 4.5% interest rate or something like that at that point in time. Great question. The last loan, by the way, that I got, which was 2 months ago, I'm paying, I think, 10% interest on that loan, which is an extraordinary high rate because of the type of property it is. A lot of banks are scared. So I bought at 4% interest, I bought at 10% interest, you know. I'm not afraid of real estate. I really like real estate. Great question. All right. If there's no more questions here or on Facebook, then we will call it. And yes, Janelli said a lot of good information. Thank you. And it is a lot. And there's so much more that we could give you, but we don't want to we don't want to inundate you with info to where like you're stuck. That's not the point of this. The point of this isn't to show you all these cool things. The point of this is to show you just enough so you can go implement. So I need some cooperation here. In the chat, please type in if you will save 20% from now on of all your money. Please just do me a favor, just say yes, 20% or whatever. That way I can see, okay, great. Thank you, Holly. So yes, Don, Kurt, Janelli. Yes, when I get a job. There you go. There you go. All right, I like that. That's what we want to see. 20%, save it forever. Open up a stock account. They're easy to open up. And then just start putting that 20% into the S&P 500. Is it better, another question, is it better to balance transfer to 0% and invest in the meantime. That's a very sophisticated move. Okay. I like, depending on what that 0% is going to turn into. Most 0% loans turn into a very high interest loan down the road. So if you go 0% for 12 months, that's fine. But if after 12 months it turns into 20%, and see, 21 months. So you have 0% for 21 months, but after 21 months it turns into, 20% interest rate, 18% or whatever. Then what I would do is, in those 21 months, I would just pay it all off. That's the point of getting zero down loans. I'm 0% transfer balances. Now, if you say, and I'm going to keep rolling it over into other 0% downs, you can, if the credit card companies, if they keep offering that, it's very risky. I don't know how it'll impact your credit. As a matter of fact, I do know how to impact your credit. I'm a realtor. It's going to impact it negatively because if you have, let's say, $10,000 and you transferred into a zero down 0% 21-month APR program, then if your limit on that is 10,000 or 15,000 or 20,000 on that credit card, you're going to be at 100% or at 50% ratio. Therefore, your FICO score is going to shoot way down. So when you go and buy, let's say, a piece of real estate, the credit that they're going to offer you, the interest rate is going to be a higher interest rate, and you might not qualify for a loan. So my thing is, you could try to, let's say, play the system. I'd rather be debt free if I'm building up my wealth. If you already built up your wealth and you have real estate, you have investments and assets, then yes, I love what you're saying, because I like playing that game too. I like playing the game where I'm able to borrow for little and then reinvest that money, because I know that my investments are a for sure deal. Whenever I do an investment, I'm not losing. If you got to that point in your investing career where you're going to win, the market's always going to go up, you're always going to make money, then you can play that game. But if you're not an expert investor, then I would just say, hey, let's pay down the debt, and then you play it more conservatively. Someone like myself or some of my friends, they could be more aggressive because they already have money. Great question. Thank you guys for joining. I appreciate you guys. Enjoy the NBA finals, and please leave us a review. You have the links in here. Claudia could, send them over again. And thank you, Claudia, our beautiful co-host tonight, and John Gaxiola, our even more beautiful co-host. I'm joking, but all right, cool. Peace out.